Hi, I'm Al Brooks, and I want to thank you for watching this video. Today I'm going to be talking about trading when a market is in a bull channel. I gave this talk at the Money Show in Orlando in 2020. This is a bonus video in the Brooks Trading course. I want to begin by talking about what a bull channel is. Basically, it's just a bull trend. If you look at the chart, if it begins at the lower left and ends at the upper right, it's probably in a bull channel. There are several types of bull channels. I classify them depending on their strength. Tight bull channels are extremely strong bull trends. They are small pullback bull trends. The pullbacks are small and brief. And when you have a very tight bull channel, you trade it exactly the same as a breakout. You only want to be looking to buy. And then a broad bull channel spends a lot of its time sideways in a trading range. The more it looks like a trading range, the more you trade it like a trading range. You buy low, you sell high, and you take quick profits. All right, so what exactly is a bull channel? Again, if you look at the chart and it begins in the lower left and it ends in the upper right, it's a bull trend. Almost always it'll have pullbacks, and that means it's in a channel, a series of higher lows and higher highs. Pullbacks can be very small. For example, right here, here's a very small pullback, or they can be big. I think of every bull trend as beginning with a breakout. Here we have 3 consecutive bull trend bars with good sized bodies closing on or near their highs. That is a breakout. A breakout can be 1 bar, it can be several bars, it can be small, it can be big. And when the market's in its breakout phase, it's in a strong phase in a bull trend. At some point, you have a pullback. The low of this bar went below the low of that bar, plus we have a couple small bear bodies, so that is a pullback. It grew for about 10 bars, but the low of the pullback held above the bottom of the breakout, the buy climax. And therefore, you think of this as a higher low, and you're probably going to get a higher high. And at that point, you're starting to think that you have a bull channel. Every trend bar is a breakout, and every breakout is a trend bar. A breakout can be several trend bars. I reserve the term breakout for bars that have a reasonable chance of beginning a trend. And a bull breakout is 1 or more bull trend bars, and they're relatively big compared to the prior bars. This is a bull breakout. This is a small bear breakout. This is a small bear breakout, but it failed. We went up. This is a small bull breakout. After 4 bear bars, it's probably not going to go very far, so this bull breakout failed. Here is a much stronger bull breakout. The close of this bar is above the high of that bar, so we have a gap between that close and this high. And it's also above the bear trend line, so it's a breakout. It lasted 2 bars. And this 3rd bar, there was some profit taking at the end. That's what that tail is. Another breakout and another breakout. A bear breakout, a big bear bar closing on its low, closing below that low, closing below this low, a minor higher low. But the next bar reversed up, so it's a failed bear breakout. The bears were hoping that this was going to be the start of a trend, but it was a bear trap. It trapped bears into hoping a bear trend was beginning. And there were more bulls willing to buy below that low, and more bulls willing to buy this close than bears willing to sell down here. The bulls regained control. A pullback in a bull trend simply means the low of the bar is below the low of the prior bar, and preferably one of the 2 bars has a bear body. That usually signifies a pullback. Sometimes a pullback can last just a single bar. Sometimes it can last many bars. Sometimes it can be simply sideways. Here, the lows of these bars did not fall below the low of any bar, but the high of this bar is below the low of that bar, so it's a small pullback. Once you start to get a pullback from a breakout, you're entering the channel phase. And here we're resuming up. So now you got to be thinking that maybe this is the low of a developing channel. So we have a spike, a pullback, and then a bull channel. A spike and channel bull trend is a very common type of trend. In fact, just about every bull trend is a variation of a spike and channel bull trend. A series of higher highs and higher lows. Channel it's weaker than the breakout phase. The breakout phase, if you're trading it, you simply buy at the market or you buy with the stop above the high of the prior bar. Once it is getting deep pullbacks, it becomes a little trickier because once you get above a prior high, you tend to get some profit taking. So traders do not want to buy above the high. They want to buy pullbacks. When you have a spike in channel trend, typically you're looking for at least 3 legs up. So the breakout is the first leg. This is the second. That's the third. And once you've had 3 legs up in a channel, you have a variation of a wedge. Sometimes you get a reversal. When you have a bull channel, 75% chance you're going to get a break below the channel. And therefore, I think of every bull channel, even though it's a bull trend, I think of every bull channel as a bear flag because there's a 75% chance you're going to get a bear breakout. And what typically happens is you have a very strong bull trend, a breakout, you have a bull channel, you have a bear breakout, and then a swing down, and then the pattern converts into a trading range. So a breakout, a channel, and then a bear breakout, and then the whole thing becomes a trading range. Very often, there'll be a sell-off down to this low or that low at the beginning of the channel, and then when you look at the screen, you'll say, the trading range began over here. So that entire bull channel, in hindsight, is usually a bull leg in what will become a trading range. Even though we have deep pullbacks, it's still a bull trend, and therefore it's easier to make money looking to buy. And that's especially true if most of the bars are above the moving average, as they are here. What's the easiest way to buy? If you know you're in a bull trend, here you're in a breakout, so it's a bull trend. Here you get another breakout. You simply place an order to buy 1 tick or 1 pip above the high of the prior bar if the prior bar closes on or near its high. And there are lots of opportunities to do this. You don't take every trade. You're simply looking to get long. If you get a reversal down, you can take profits and then look for the next buy signal to buy again. Once you're long, you look down to the bottom of the most recent breakout, and that's where you put your stop, 1 tick or 1 pip below the bottom of the most recent breakout. If you bought here and you did not exit and you held long, once it starts to turn up, either here or here, instead of your stop here, you'd raise your stop to here. Once the market is up here, well, let's say over here, we're starting to break out again. The stop for the traders who bought here is below the bottom of the most recent leg up, the most recent breakout. Their stop is here. And the traders who bought anywhere earlier, if they're still long, they raise their stop to below the bottom of the most recent breakout down here. So your stop placement is not related to your entry price. Your stop placement is related to what the price action is doing. You want your stop below the most recent breakout after a bull trend resumes. So you look for a resumption of the bull trend. If the resumption is reasonably strong, 1 big bull bar, 2 big bull bars can be enough to decide that the stop should be raised. Sometimes it takes 3 or 4 or 5 smaller bars, and then you raise the stop to below the bottom of that leg up. When the market's in a bull channel, there are often several opportunities to sell. For example, here we have a buy climax and a reversal down. You could call it a parabolic wedge. 1, pause, 2, pause, 3 legs up. So this is a tight bull channel, and you have a decent sell signal bar. So it's reasonable to sell below either of those bars closing on their lows. You're not looking for a bear trend. You're looking for a pullback. Here we pull back for about 10 bars. Maybe here we'll pull back for about 10 bars. You have a bull channel. When you look at it, you can buy, you can sell, but if most of the bars are above the moving average, and most of the pullbacks do not get far below the moving average, and most of the pullbacks stay above the most recent high or low, then you should be looking mostly to buy, although sometimes there are some sell opportunities. I also look for consecutive big bear bars closing below the moving average. We have a small bear bar here and a big bear bar here. The bears really needed one more bear bar, and they did not get it. If they had a second bear bar that looked like this, then we'd have the opposite of this, consecutive big bull bars. You're probably going higher. The bears almost did what they needed to do. They had one big bear bar. They did not get a second. And that's a bear trap. And because traders will look at the market differently if the bears get two big bear bars closing below the moving average, a lot of bulls will buy the close of that bar, betting that the bears will be unable to get a second consecutive big bear bar. Another example, the bears needed probably one more good-sized bear body to take control over the market. The bulls knew that, and the bulls bought that close, trying to prevent the bears from getting their second consecutive bear bars. When you're in a bull trend or a bull channel, most of the stop entry sell signals will lose money. The stop water bears, they're mostly going to lose money. For example, you're not going to sell below here. You're not going to sell below here. Here you might have been able to make a little money, but not much. You're not going to sell below there. If you did, you would have lost money. If you sold below here, you would have lost money. If you sold below here, betting on a continuation of the bear trend, you would lose money. This is a pullback, and the bottom of the pullback overlaps the breakout point. We have a breakout above this high, and the rally continued up, but it pulled back below that high. Here we have a breakout point, a reversal down, and we broke above it. Not a very strong reversal, but again, look at the low of these bars. The pullback fell below the breakout point. That's a stairs pattern, and whenever the market is having a stairs pattern, you will get bears placing limit orders to sell at the prior high and sell more higher, betting that either the market will go right down and they can make a profitable short, or it'll come back to their original sell and they'll get out, break even on their first sell, and with a profit on a higher sell. If the pullbacks are big, here we retraced more than half of the breakout. Here we retraced about half of the bull breakout. Bears will start to sell. But if you're going to sell, you want to sell early, you want to sell high, and it's better to sell below a bear bar closing on or near its low. And if a bull channel is tight, the probability is higher if you wait for a couple bear bars or if you wait for a second sell. This is a very strong rally. Nobody's going to sell there. Some traders might want to sell here, but it's also a bull bar. Instead, if they're going to sell, they'll sell here, betting that maybe we'll retrace half of that rally. They're looking for a scalp. If you're selling in a strong bull trend, you're looking for a small profit, your scalp. We broke above this high to a new high, and we pulled back. And the pullback fell below the breakout point. So if a bear sold with a limit order at this high and sold more higher, he could place a limit order to exit his entire position back at this high. He would get out break even on his first sell and with a profit on his higher sells. A stairs pattern. The legs overlap. The pullback down overlaps the last breakout point. If you're a bear in a bull channel, you're looking to sell, you want to see pullbacks overlapping breakout points. This pullback overlaps that breakout point, because then you feel confident about selling at a prior high and or higher. Breakout point, pullback. The pullback came below the breakout point. Bears are going to make money. They sell that high and they can make a small scalp. And they'll keep selling at prior highs, betting that they'll continue to make money. Bull trend. Some bears will automatically sell at the prior high, especially if you have that deep of a pullback. They'll bet that whatever breakout we get here, we'll retrace about half of it and pull back below the breakout point. If a bear sold here, he did not get to make money here, but he's probably going to sell more higher, either a certain number of ticks or pips higher or on a reversal down. And once it comes back to his original sell price, he gets out break even with a profit on his higher sell. It's easier to make money buying a reversal up from a pullback, buying above a bull bar here, buying above a bull bar here. Bull bar closing near its high, buy above that bar. a breakout, not all that strong. We have a breakout bar here, follow through bar here, a bull bar, increases the chances that will go higher. This bar closed above the high of that bar and above this prior high. So it's a breakout. You expect some kind of a pullback. We have a pullback here. It continued more sideways. And then you expect the market to enter a channel. So other legs up and pullbacks. And at some point, you expect a bear break below the bull channel and a sell-off. And then when you look back, the whole thing is a trading range. The bull channel turns out to be a bull leg in a trading range, and the sell-off is a bear channel, and it's also a bear leg in the developing trading range. The reversal down more often than not, comes back to around the bottom of the first pullback where the bull channel began. Bear bar went below the low of the prior bar, and the bull breakout has probably ended. And this is probably the start of the pullback phase. Three legs down, 1, pause, 2, pause, 3, possible wedge bull flag. And now we have a bull breakout above that small bear trend. The bull trend is resuming. Bull channel acts like a bear flag, 75% chance you'll get a break below the bull trend line and then a transition into a trading range. We have one push up, a second leg up, and a third leg up. Very often, bull channels will reverse after a third leg up. I think of that as a variation of a wedge, even if it's not converging. Now, what do you see here? Well, you see a lot of bull bars, but look at the low of this bar and the low of that bar. Its low is at or above that low. The low of this bar, it's at or above that low. The low of this bar, it's at or above that low. And 14 bars we did that. When you have lows that do not pull back below the low of the prior bar, you're in a microchannel. This is a 14-bar bull microchannel. It ended once there was a bar with a low below the low of the prior bar. A bull microchannel is a sign of very strong bulls, but it's also usually a parabolic wedge. They're usually at least 3 legs up. We have a leg up and a smaller bar, bull bar, and then a smaller bar, another series of bull bars. And therefore, you can think of this as a breakout and a parabolic wedge channel. We're trying to break above the top of it, and we're reversing. This is a biclimax. Remember, every bull trend bar is a breakout, and it's also a climax. Sometimes it'll lead to a trend, sometimes it'll reverse, sometimes it'll go sideways. When it is extreme like this, especially when it's a third leg up, 1, 2, 3, it's going to attract some profit taking. You expect at least a small two-legged pullback, 1 pullback 2, or maybe 1 pullback 2, or 1 pullback 2. Now, I said bulls will be buying closes and buying above the high of the prior bar, and they'll do that all the way up until they get disappointed. The bulls will buy above the high of the prior bar as long as bars are closing near their highs, or they'll simply buy at the market when a bar closes above its midpoint. And they'll keep doing that until they get disappointed. If they see a bear bar closing near its low, they know we're in a buy climax, they know it's the third leg up, and they know this is possibly a parabolic wedge nested within a wedge. If you're a bull and you bought that close, you're disappointed by this bar. What are you thinking? Some of the bulls will think, well, the first attempt down will fail, I'll buy more lower, and then I'll try to exit if it comes back to my original buy. Traders pay a lot of attention to this test back up. The odds are high the first reversal down will be bought. The bulls will buy that low. They'll buy lower, 5 ticks, 10 ticks lower, 5 or 10 pips lower, betting that we'll come back up and test that close. And sometimes the bull trend will continue up. Other times it'll continue up, and for an instant it'll be a very big bull bar, and then it starts to pull back. And what does that tell you? It tells you that the bulls who bought this close were sufficiently disappointed by this bear bar that they want to get out. So the bulls are selling out of their longs here. And the bears will sell on the test of this close as well, trying to make the bulls give up. And if you get that tail at that close, it's a sign the bulls are giving up. And we might get a couple legs sideways to down, or you may even get a bear trend. Micro double top, lower high, but a double top, and a second reversal down. One, pullback, two. Traders will start to look to sell below bear bars, especially bear bars closing near their lows. All right, so we're in a bull trend. We have a deep pullback below that low. We have a new high, higher low, a new high, a deeper pullback. So possibly a wedge here, but the reversal down did not get very far. And then we have a new high here. So we're starting to get a series of higher highs, and we have higher lows, and it's starting to converge. Remember, anytime you have a bull channel, 75% chance you're going to get a bear breakout. So you have to be looking for a reversal down. We tried to get a wedge here. We had a bear breakout below the wedge. I don't have the line drawn in, but the bear breakout did not succeed. We got a reversal back up to a new high. Anytime the market breaks above the top of a wedge, 50-50 chance you're going to get a new stronger leg up, a couple legs up. 50-50 chance the breakout will fail and you'll get a reversal down, a second reversal down. Breaking above the top of the wedge, and we have a bear bar, consecutive bear bars, an outside down bar. Traders will start looking to sell. For example, they'll sell on a stop below that bear bar, or a bear bar closing on its low, they'll sell below its low over here. Betting that we'll get a couple legs sideways to down. It could be 1, 2, or it could be 1, pullback, 2. We have a bull channel, and we have one push up, a second leg up, a third leg up, did not reverse down. But here we're getting a bull breakout and a follow-through bar with a bull body. This looks like it's going to be a successful breakout above a bull channel. How is this different from what I just showed? I said 75% chance if you have a bull channel, you'll get a bear breakout and a conversion into a trading range. 25% of the time, you're going to get a successful breakout. If you have a small pullback bull trend, it's always forming wedge tops. There'll always be a series of wedge tops. More likely than not, if you get a bull breakout above a small pullback bull trend, instead of getting a reversal, you're going to get another leg up. So this is the one exception. If the bull channel is tight and the pullbacks are small, just 1 or 2 bars here, 1 bar here, 1 bar there, no pullback over here, then you're not looking for a reversal. You're looking for a breakout. So if you're in a small pullback bull trend, it's always going to have wedge tops. If you see a breakout, especially with the follow-through bar, don't look for it to reverse down. Instead, look for it to continue up. Small pullback bull trend and you get a bull breakout. I would say if the trend is strong, there's going to be at least a 50% chance that you're continuing up. If the bull trend is not too tight and are a lot of bear bodies, maybe 50-50 chance the breakout will reverse. If you get the breakout, you're looking for some kind of a measured move, possibly based upon the height of the channel. The channel began here, the breakout's here, so maybe a measured move from that low to this high up here. Here's the breakout. It broke out of something. It broke above that high, and it broke above the top of the wedge bull channel. We have a follow-through bar, so we might go up for a measured move, which we ultimately did. I like this chart. This is the 87 crash. I started trading back here right before the 87 crash. The market fell 20 to 25% in one day, depending on which market. There was talk about a wedge rally, but there's something about this wedge rally. What do you notice? It's a monthly chart. The pullbacks, if you're looking at a daily chart, the pullbacks are big. But on the monthly chart, it's really a pretty tight bull channel. It's a small pullback bull trend. And what happened over here? 1 bull bar, 2, 3, 4, and the bull bars all are closing on their highs. So this is a bull breakout above a bull channel, and it led to a huge bull trend. This is 1995, when the Republicans took over Congress. This is the most dramatic example of a bull breakout above a wedge bull channel that I know of. And it was really dramatic. The stock market just went way, way up after the breakout. A series of bull bars closing on their highs. So a buy the close rally. So from a small pullback bull trend into a breakout phase. If this was a yearly chart, every bar being 1 year, it would be simply a big breakout. On the monthly chart, it's 2, 3, 4, 5, 6 bull bars closing on their highs. That's a very strong breakout. The market is certainly going higher. Nobody expected that much, but that's what we got. How do you trade it? Well, after you've seen 2 or 3 bull bars closing on their highs, 4 or 5 bull bars closing on their highs, you got to get long. You simply enter at the market, or you can simply place a stop order to buy 1 tick above the high of the most recent bar. And you trade small. This is a monthly chart, so the stop is down here, and it's pretty far below. So you have to trade small enough so that your stop will not result in a bigger loss than you would get on any other trade. You don't take all of these buys, but at some point after 3, 4, 5 bars, you have to get long, put your stop down here, and then just wait and enjoy the ride. I have 4 examples of bull channels here. In a bull channel, traders buy at the moving average and on a reversal up. It's easier to make money buying a series of higher lows, higher highs. This is your common type of bull channel where it's not tight and it's not broad. And this is the other extreme right here, very tight and very broad. When you have pullbacks that last 5 or 10 bars, you will get bears selling above prior highs and with stop orders on reversals down. So limit order bears will sell with a limit order at the prior high, sell more higher, and look for a scalp, a small profit. Easier to make money buying, plus a buy you can swing if you want, and for the bears it's only scalps. This is a very tight bull channel, a small pullback bull trend, pullback only lasting a bar. Here it lasted several bars, but it did not fall very far down. It's impossible for bears to consistently make money in a small pullback bull trend. So unlike your garden variety bull channel, if it's a small pullback bull trend, you treat it like a breakout and you only look to buy. On a higher time frame, this is a breakout. You don't see any pullbacks on a higher time frame chart. This is an extreme example of a small pullback bull trend. It's a micro channel. We're getting bear bars, but every low is at or above the low of the prior bar. So a very strong version of this. Since you should only buy in a small pullback bull trend, if you're in a micro channel, a very strong type of small pullback bull trend, you should only buy as well. However, this is so extreme, you often get a climactic reversal, a pullback that lasts more bars and falls lower than what you would expect based upon how strong the trend is. Now, you can call this a trading range, and for a lot of the time, it is a trading range. But we have a higher low, a higher low. We have a higher high, another higher high, and another higher high. So it's a broad channel, but it's basically a trading range that's tilted upwards slightly. And since it looks a lot like a trading range, you can trade it like a trading range. Traders will look for reversals down from the top, and they'll look to buy reversals up from the bottom. So they sell high, they buy low. And since it's not going to go very far up or down, or it has not been doing that, they'll take relatively quick profits. So this is extremely bullish. This is extremely sideways. The more sideways it is, the deeper the pullbacks, the more traders will both buy and sell. And the smaller the pullbacks, the tighter the channel, the more traders should only be looking to buy. I mentioned earlier that if most of the bars are above the moving average, then it's a bull trend, and traders should only look to buy. Okay, your garden variety bull channel. Series of higher highs and lows. We have a very strong bear breakout. a brief channel and then a breakout above the bear trend line. And we have a series of bull bars. And this is a bull breakout. We're breaking out above that bear trend line. We're breaking out above this lower high in the bear trend. So it's a spike up. Not much overlap between the bars, several bars closing on or near their highs. At some point you get a pullback, and then you'll expect a channel up. Breaking out above a lower high, possible start of a series of higher highs and higher lows. So now we have a higher high and we're starting to turn up, so a higher low, possible bull channel. We keep making new highs, so we're in a bull trend. We're getting higher highs and higher lows. We're in a bull channel. Easier for traders to make money looking to buy pullbacks, possibly taking partial or full profits at a prior high. Easiest way to trade it, you look for a pullback. Pullback could be brief, just a few bars. And then if you get a bull bar closing on or near its high, you enter with the stop above the high of that bar. And you put a protective stop below the most recent swing up. If you buy that, where's your stop? Is your stop here? Well, I probably would put it here. We have a new high here. This leg up began here, so I probably would put my stop there. Now, we're getting higher highs and higher lows. What do you think the reversals down will do? You have to bet that the bear breakout attempts will fail. So aggressive bulls will bet that the bear reversal attempts will fail. They'll buy at the market when a bear bar closes, or they'll place a limit order as soon as it closes to buy at the close of the bar on the open of the next bar. Problem with that is sometimes you do not get filled. So for example, if you placed a limit order as soon as this bear bar closed to buy at the close of that bar, you probably would not have been filled. It looks like the low of this bar did not fall below the close of that bar. So better to be buying at the market. Some traders will simply buy with a limit order at the moving average, at the average price, betting that the market will get back above average and stay above average. So if most of the bars are above the average price, the average is going to go higher. Some traders will also place limit orders to buy somewhere in the middle of the last leg up. Other traders, if the market is pulling back, will buy with a limit order below a bull bar, betting that there will be more buyers than sellers below the bull bars. All right, we're rallying. We have a close above the high of these bars and a close above this lower high in the bear trend. But we have a pullback below the breakout point. And therefore, traders are thinking maybe it's a stairs pattern. The breakout is not all that strong. We're following a lot of sideways bars here, a lot of bars with prominent tails, a lot of alternating bear and bull. This trend is probably not going to be all that strong. It'll probably be a stair pattern. So every time you get a new high, expect a pullback below the prior high. And when that's the case, you'll start getting bears selling at a prior high and selling more higher, and then getting out break even at the prior high. If it immediately goes down, for example, if you sold at this high and it did not go up high enough to sell more, you simply sell here and hope that it goes far enough down for a scalp, and you take profits somewhere down in here. Bears will also sell on reversals down, especially if it's a second reversal down from above a prior high. The bears are looking for a small profit, so they're going to scalp. So they have to exit. They have to be pretty quick to take their profits. It's a mistake to bet that when the market is channeling up, you're going to get a bear trend. So you have to have a plan to take profits. Don't hold hoping that you're going to get a bear trend, because you're probably not. Bears selling at a prior high and on a reversal down, and they're looking for a small profit. Same thing, selling at the prior high or on a reversal down below the low of that bar, small profit. Very small profit potential for the bears. Much easier to make money as a bull. The profits are bigger and the probability is better. If a bear sold this reversal down, we're trying to reverse, and a second time up, I would get out, especially above a bull bar. A second attempt to resume the bull trend at the moving average and a bull bar, that is a buy signal, and you should not be holding short in a bear trend if you have a credible buy signal. Tight bull channel. We're getting new highs, and the pullbacks are very small, very brief. Some of them are simply sideways. It's a small pullback bull trend. And when you see a chart like this, you can say, well, a lot of prominent tails, small bodies, it's not a very strong bull trend. Well, in fact, if you think about it, if the pullbacks are very small like that, if you go to the next higher time frame, there may not be pullbacks at all. So this is probably a breakout on the next higher time frame. If it's a breakout on the next higher time frame, on this time frame, you should only be buying. Here we have a trading range, mostly sideways, but we're holding above the moving average and we're making a new high, testing the moving average, reversing up. The pullbacks are small. Even though we went sideways for 6 or 7 bars, the actual drop from the high is small. So you're going to be thinking that it's holding above the moving average and we have small pullbacks. This might be the start of a small pullback bull trend. And now we're not getting pullbacks at all. We're getting sideways moves, but every low is at or above the low of the prior bar. And that was the case from this bar to that bar. We finally have the low below the low of the prior bar. So we finally have a pullback. We went up for 25 bars without a pullback. That's a 25 bar bull micro channel. Yes, it's unsustainable. At some point, you're going to get profit taking. It's climactic, but it's also a very strong bull trend. Look at the pullbacks here. They did not overlap the breakout point. Again, here, we're pulling back, did not overlap the breakout point. So these green lines represent open gaps. Pullback here could not get below the breakout point. So the bears cannot make money. Here we have body gaps. The low of this bar is below the breakout point, but the lows of these bodies held above the highs of these bodies. So I call that a body gap. Again, the low fell below the breakout point, but the body gaps are still there. These bodies did not overlap that body. And that is a type of gap, and therefore it's a sign of a very strong bull trend. If you're trading this, you can only buy. The bears cannot make money. Anytime you look at a chart and you conclude that the bears cannot make money, you have to buy. And you can buy for any reason. You can buy at the market. The easiest way to buy is just look for any bull bar and place an order to get long 1 tick or 1 pip above the high of that bull bar. You don't have to take every buy, but you have to take 1 buy. This is the same chart. This is a 5-minute chart. And even though it never looks all that strong, it has a lot of very small bars, small bodies, prominent tails. It looks like a bull leg in what would become a trading range. But the pullbacks are small. They're non-existent. And when that's the case, if you look at a higher time frame chart, here's a 30-minute chart, it's a bull microchannel. It's 8 consecutive bull bars. It's a breakout phase. And if you're looking at this, do you want to sell? Of course not. And therefore you should not be selling here. I want to clarify. I talked about this as a 25 bar bull microchannel. It's a very tight bull channel. It's a small pullback bull trend. There were pullbacks along the way here and here and here. But from this point on, it was a 25 bar bull microchannel. So this is the start of the bull microchannel. And the small pullback bull trend began down here. Again, impossible to make money selling, even with limit orders. you should only look to buy. At some point, there'll be some profit taking, a possible final flag, a tight trading range, late in a buy climax, 25 bars from here to here without a pullback. That is climactic. At some point, you're going to get a pullback. And we tried to resume up. This became the final bull flag. So if you're long and you're getting a reversal down, reasonable to get out below a bear bar, because a lot of bulls will start to take profits. And after a buy climax, the profit taking can last longer. And drop the market lower than what you think is reasonable. Again, a lot of very small bars, a lot of sideways bars, a lot of small bodies, prominent tails. It appears to be a weak rally, and therefore it appears to have low probability of a big profit. And it also always looks like it's about to convert into a trading range. So it appears to have small potential reward if you think it's going to soon reverse into a trading range. The stop is far below. So if you're buying up here, the stop is pretty far down, so the risk is big. And it appears to have small reward potential because you think it's going to convert into a trading range. And therefore you think it has big risk and small reward. In other words, bad risk reward. But remember, on the next higher time frame, it's a breakout. A breakout is a high probability trade. The risk is big because the stop is far below, but it's a high probability of a big reward. So when you look at this, think about it. It's a breakout on the next higher time frame. So it's not low probability. It's high probability and high profit potential. So this is a high probability of a big reward. It's a breakout on the next higher time frame. Yes, the stop is far, so the risk is big. So high probability and big profit potential. I often talk about trading stupid. Don't think too much. Don't try to convince yourself into believing that the bull trend is going to convert into a trading range. These small pullback bull trends often look like this, but you look at it and say, hey, wait a minute, that pullback is only one bar and it didn't fall very far. Hey, same thing here. It's a small pullback. Here, it's a pullback that just went sideways. It's a small pullback and we're in a bull trend. This is a small pullback bull trend and it can last a long time. Once you decide it's a small pullback bull trend, you got to get long. Look for any bull bar closing on or near its high, buy with a stop above the high, and put your protective stop below the most recent leg up. There were lots of opportunities to get long all the way up. Also, if you get bear closes, you have to assume the pullbacks will remain small. You can buy the close of bear bars all the way up, any of these bear bars. You can buy at the market. You can bet that the pullbacks will be small. And that means brief and small. You can buy with a limit order at the low of the prior bar, betting that the pullback might just last a bar or two. So that's another way to get long. Lots of ways to get long. A broad bull channel spends a lot of time going sideways. It looks like a trading range that's tilted up somewhat. You trade it like a trading range. We have higher highs, higher lows. It's a bull channel, but it's mostly sideways, and therefore you trade it like a trading range. Broad bull channel often has lots of time when it's going sideways. We have a very small trading range here, another one here, bigger trading range. Sometimes you have trading ranges within trading ranges. Small trading range here, it became part of a bigger trading range. A lot of time within trading ranges. It spends so much time going sideways, it's easy not to notice that it's also a bull trend, higher highs and higher lows. It doesn't matter because you're going to trade it like a trading range. It has so much trading range price action, you trade it like a trading range. Buy low, sell high, and take quick profits. Scalp. Possible double bottom. And now we have a higher high and a higher low. It's possible that this is going to be a bull channel, and it was. It was a bull channel within a bigger bull channel. Mostly sideways. Buy low, sell high, scalp. When you have trading range price action, the reversals are often not clear, and you often get additional legs that go against you. So skilled traders will use wide stops and scale in, betting that if they do not pick the exact top or the exact bottom, the market will not. Not go too far against them before it goes their way. Most traders are better off waiting for a second reversal. Possible wedge bull flag, a lower low, 2 legs down, 1 pullback 2. So instead of buying above that bar, wait for a second attempt to go up, an outside up bar here, or a third here. Trying to reverse up here, but a 6-bar bear microchannel, 5-bar bear microchannel, better to wait for a second buy signal above that bar, or a bull bar closing on or near its high. 2 legs down, 1 pullback 2, so you can argue that's a second attempt up. Here we got reversal up, reversal up, reversal up, and we got a new low. You can take these buys, put a stop down here or here, but you have to be willing to have the market go against you, because in trading ranges, very often, the first entry will not be the end of the move that goes against you. Different ways to draw a wedge. You can also call it high 2. Here we have 3 lows, so a wedge here, and first reversal up here, small doji after a big bear bar. I would wait for a second buy signal, and we have it here. So this is a small high 2, high 1, high 2, a second buy signal. That's a reasonable buy. We're starting to trend up in a small pullback bull trend. We have lots of room to the high. Traders will buy above bull bars closing on their highs. First reversal up, very tight bear channel, probably not going very far. And now we're reversing up a second time. It's a higher probability trade. Did not get up very far, but that is a higher probability buy than that. If you took this buy and you held, hoping to go up here, and instead we got that reversal down, I would exit below that bear bar. Reversing down from a buy climax, 2 attempts to go up, both failing. So I would not sell below the first reversal down, but this is a small double top here. I would sell below that bear bar. Second entry. Tried to reverse down here from a double top. Did not get very far. Higher probability. Take the second signal. You can see how so often the signals do not look all that good. Better to wait for a second signal, use the appropriate stop, and go for a quick profit. We have a wedge rally and a double top, a decent bear bar. If you want, you could go for a second signal, but did not get very far. So if you took this second signal and we're reversing up and reversing up a second time, if anything, you're looking to buy here. It would be pretty hard to hold short if you sold below that bear bar and we had 2 bull bars trying to reverse up. Very difficult for most traders to trade. This is, I think, a really difficult example of a broad bull channel because there are just so many reversals. Very difficult. Most traders, if they see a market like this, they should take very, very few trades. We have a wedge top, and then we have another way to draw a wedge top, or even here, 1, 2, 3, 2 legs up, 1 pullback 2. Traders might take the first reversal down, or they'll wait for a second reversal down, or here. We have a high, a higher high, and a higher high, and a low and a lower low. It's an expanding triangle. We're breaking above the bull channel. Credible sell below the bear bar. Higher probability to wait for 2 or 3 bear bars and then sell. I showed this slide earlier, and this is a pretty ordinary bull channel. Easier to make money buying. Most of the bars are above the moving average. Better to buy pullbacks. Although the bears can make scalps. We have a stairs pattern. Bears can sell with limit orders at prior highs looking for scalps. When the pullbacks are very small and it's very difficult for bears to make money even with limit orders, it's a small pullback bull trend. You should only buy. It'll be a breakout on the next higher time frame. A microchannel is an extreme version of a small pullback bull trend, and it always is a breakout on a higher time frame. You can only buy. Once you decide that it looks like a small pullback bull trend, especially a microchannel, and you're flat, look at any bull bar closing on or near its high. Place an order to buy on a stop above the high of that bar. You have to get long. A broad bull channel, we have higher highs, higher lows. It's mostly a trading range that's tilted up. Traders are going to buy low and sell reversals down, sell high, and scalp. If most of the bars are above the moving average, it's usually easier to buy, and therefore you should focus on buying. I talked about what a bull channel is. It's simply a series of higher highs and lows. A common bull channel, easier to make money buying, but if the pullbacks overlap the breakout points, a stairs pattern, some traders will also look to sell for scalps. When a bull channel is very tight, a small pullback bull trend, it's a breakout on a higher time frame chart, you should only be looking to buy. If a bull channel is very broad, very deep pullbacks, and it spends most of its time going sideways, traders will trade it like a trading range. They'll buy low, sell high, and take quick profits, scalp. I'm Al Brooks. Thank you for watching this video on trading when a market is in a bull channel. Hi, I'm Al Brooks, and I want to thank you for watching this video. Today I'm